Welcome to the deep dive. Our mission, as always, is to cut through the noise, turn those dense reports into some surprising facts, maybe those aha moments you can actually use. Today, we're looking into the transformation of L&T Finance Ltd, LTF, and we're zoning in on two really big, very recent things. Their Q1 FY26 results, and this is crucial, their first ever international credit ratings.
That's right. And just so you know, our source material for this is bang up to date. It's all from July 18, 2025. We've got press releases directly from S&P Global Ratings and Fitch Ratings, plus LTF's own unaudited financials and their investor presentation. It's quite comprehensive.
Okay, right. Let's unpack this then. We want to go beyond just the headlines, really distill what these developments mean for LTF itself, how they fit into the bigger picture of the financial sector, and maybe what signals they're sending about finance in India. And that first big piece of news, well, it's a real headline grabber. L&T Finance has managed to secure its first investment-grade credit ratings from the big international agencies, S&P Global and Fitch. I mean, this feels like a pretty pivotal moment for them.
Well, absolutely, it's huge. So S&P gave them a BBB long-term rating and an A3 short-term one. And importantly, the outlook is positive. Fitch also came in with BBB for their long-term issuer default rating, both foreign and local currency. That one has a stable outlook. Now, in IDR, that's basically Fitch's view on how likely they are to meet their financial commitments. But the really extraordinary part, these BBB long-term ratings, they're investment grade. Signals lower risk, right? And they got these on their first try, matching India's own sovereign credit rating.
Wow. Okay. Matching the sovereign rating straight out of the gate. That's quite a statement, isn't it?
Right.
What does that actually tell us? I mean, about how the world sees LTF, but maybe also about confidence in the Indian financial system right now. And practically speaking, what doors does this actually open?
Well, it signals a massive amount of confidence, really, from major global players. They're seeing LTF as, relatively low risk, but with high potential. And practically, these ratings are foundational. They basically give LTF the key to tap into global capital markets. That means access to potentially cheaper money, a much wider pool of international investors. It really diversifies where they get their funding from. It's a game changer for their financial flexibility.
Right. Access and potentially better rates. Makes sense. So why now? What were the core reasons these agencies gave for such a strong positive rating?
Okay, so the rationale from both S&P and Fitch really hammered home one point, the backing from the parent company, Larsen Toubro. L&T. S&P was very clear. LTF benefits hugely from this relationship. L&T holds, 66.24%. And big stake, S&P expects L&T will provide ongoing, even extraordinary support if needed. They see LTF as strategically vital, contributing more and more to L&T's bottom line. Plus, the shared brand means L&T's own reputation is tied up with LTF's success. Fitch echoed that. Their ratings are also, quote, support-driven. They highlighted LTF's role in the group strategy, the large shareholding, the shared brand, all the same points, really. And just to put some numbers on it, LTF's net profit was about 11.6% of L&T's total consolidated net profit in FY25. That's up quite a bit from 7.8% back in FY22. So its importance is growing. Fitch did also mention LTF's own strengths, its moderate standalone profile. They acknowledge it's one of India's biggest NBFCs, non-banking financial companies. These are like banks, but often more specialized. LTF has a pretty diverse loan book, around $11 billion USD at the end of FY25, experienced managers, and getting better at managing risk.
Okay, so that parent support is obviously a massive factor, a huge safety net. But does relying so much on the parent ever, limit LTF? Does it constrain their own independent strategy or growth?
That's a fair question. I mean, while that strong L&T link definitely provides stability and probably helps with funding, LTF's also shown it can forge its own path. Look at their big push into retail lending, their digital stuff. That seems very much internally driven. It aligns with L&T's vision, sure, but it doesn't feel like they're just following orders. The support is foundational, yeah, but maybe not stifling.
Okay. So the international ratings paint a picture of a company ready for the global stage. Let's bring it back home, though. What do their latest financial results, the Q1 numbers, tell us? Is that potential showing up in actual growth and resilience on the ground?
Yes, it seems to be. So for the quarter ending June 30, 2025, their consolidated profit after tax came in at R701 crore. That's roughly, $84 million USD. That figure is up 10% compared to the previous quarter and 2% compared to the same quarter last year. They also hit their highest ever consolidated book size total loans, basically are, 1,002,314 crore, about $12.2 billion USD. That's a solid 50% jump year on year. But here's the really interesting bit strategically. The retail book, that grew to Rs 99,816 crore, an 18% year-on-year increase. And the big achievement, retail lending now makes up 98% of their entire loan book.
98% retailization. Wow, that sounds huge, and you said it's ahead of their own target. But what does that actually mean for the company? Is it just a number, or does it change their risk, their profitability?
Oh, it's much more than just a number. It's fundamental. Think about it. They've shifted away from having maybe fewer but much larger loans to big corporations, which can be quite risky if one goes bad. Now they have millions of smaller loans spread across individuals, small businesses. It massively diversifies their risk. You don't have all your eggs in one basket. It should, in theory, lead to more stable, predictable income streams, even if the profit on each individual loan is smaller. It's like building a fortress against big shocks, a move towards resilience.
Right, spreading the risk. That makes sense. So which parts of retail are driving this growth? Where are the actual loan disbursements happening? And how are they managing the cost of all this borrowing they need to do to fund it?
Good question. So retail disbursements in Q1 FY26 totaled Rs 17,522 crore. That's up a healthy 18% year on year. A lot of that came from secured loans, things like farmer finance lending to farmers, that was up 16% year on year. And home loans plus loans against property, or LAP, they saw a big 24% jump in disbursements. But unsecured personal loans also saw, well, massive growth. Disbursements there shot up 65% year on year, reaching Rs 1,942 crore. And on the cost side, they seem to be managing okay. Their weighted average cost of borrowing, the WACB, actually came down slightly by 16 basis points of 0.16% quarter on quarter. It's now 7.68%. They put that down to being smart about repricing their liabilities.
Okay, solid growth numbers, but hang on, 65% growth in unsecured personal loans. That sounds great for revenue, but isn't that segment inherently riskier? How do they square that kind of aggressive growth with saying they have stringent underwriting? Is there a risk they're taking on too much?
That's the million-dollar question, isn't it? And LTF seems aware of it. They do explicitly say they're focusing more on prime borrowers, people with better credit histories, and they're leaning heavily on technology, their AI tools, to assess risk better. They describe this personal loan growth as calibrated and digital-led, with strong risk management built in. So while the percentage jump looks huge, it's likely they're using those AI engines like Project Cyclops we'll probably talk about to be much more selective, maybe targeting existing customers they already know well. It's probably not just lending wildly, but a very targeted expansion using better data.
Right, using tech to hopefully mitigate that risk. Makes sense. Okay, so looking beyond just the quarterly numbers, what are the bigger strategic shifts happening behind the scenes that are enabling this performance and this whole transformation story?
Well, a really key piece was simplifying their structure. Back in late 2023, they merged all their subsidiary companies into the main entity. So they went from being a kind of holding company overseeing different bits to being one single operating non-bank lender. Much cleaner. And you really see the impact of that strategic focus in the numbers, especially the near elimination of wholesale lending. Down to just 3% of the book now, from almost half, 49% at the end of 2022. That's a huge deliberate pivot to retail.
That's a dramatic shift. Okay, so they've streamlined what they had. Are they adding anything new to the mix? Any new products or strategic acquisitions?
Yes, actually. A pretty significant one quite recently. In June 2025, they acquired the gold loan business from a company called Paul Merchants Finance. That deal brought in over 130 branches, around 700 employees, and a loan book of about Rs 1,300 crore, roughly $155 million USD. Strategically, this makes a lot of sense for them. Gold loans are generally high yield, plus they're secured by the gold itself. And the real kicker is the cross-sell potential. LTF already has this massive customer base in rural areas, about 6.5 million active customers in their rural group loans, microfinance, and farmer finance segments. And guess what? Those customers apparently already have over Rs 16,000 crore. That's like $1.9 billion USD in gold loans, but with other lenders. So LTF sees a huge opportunity to offer this product to their existing base.
Ah, okay. Tapping into their existing rural network. That's smart. Now, you mentioned technology earlier. Let's talk about Project Cyclops. An AI-driven digital credit engine sounds fancy, but how does something like that actually, tangibly improve things? Can you give an example?
Sure. So Project Cyclops is their own in-house developed system. Think of it as a super smart brain for deciding who gets a loan and how risky they might be. In their two-wheeler finance business, for example, Cyclops is already making a difference. It apparently crunches way more data points than just a standard credit score. Maybe things like transaction history, digital footprint, I don't know exactly, but it does it fast. This means quicker loan approvals for good customers, which people obviously like, and hopefully more accurate risk assessment, which means fewer loans going bad down the line. They've also rolled it out in their farm business, just launched it for SME lending, and personal loans are apparently next, expected by Q3 FY26. And it's not just Cyclops. Their customer app, Planet, has got like 18.6 million downloads. It's handled huge amounts in loan repayments over R's, 4,800 crore, and even sourced a ton of new loans over R's, 15,500 crore. So digital is definitely core to their strategy now.
Okay, so the tech, the acquisitions, it all seems geared towards this big retail push. But let's circle back to risk. Pushing into these segments, even with AI, still carries risk, right? Rural finance, microfinance. How good is their actual asset quality? How are they managing potential loan defaults?
That's absolutely the critical counterpart to the growth story. And yes, they operate in segments that are often seen as higher risk, higher reward, like you said, rural, microfinance, farmer loans, two-wheelers. That's about 55% of their lending. But they stress they use stringent underwriting. They've apparently tightened rules, like limiting how many loans someone can have from different lenders at once. And in two-wheelers, they say they're lending more to prime borrowers now. The key metrics look okay, actually. Gross Stage 3 loans, those are the ones considered non-performing or in default, stood at 3.31%. Net Stage 3, which accounts for provisions, was lower at 0.99%. These levels suggest they're managing to keep bad loans relatively contained for now. But here's something really interesting they did in Q1. They proactively used R's 300 crore, about $36 million USD of what they call macro-prudential provisions. This was from a pot of money, about R's 975 crore or $117 million USD, that they'd set aside specifically for their rural and microfinance loans back during the COVID years, FY21 and 22. Think of it like a dedicated rainy day fund for that specific segment. And why did they dip into it now?
Well, they cited a few reasons. The prolonged heat wave impacting rural incomes, severe floods in some areas, a temporary slowdown in rural employment schemes because of the general elections. There were also some specific challenges in the state of Karnataka due to a new ordinance about preventing coercive collection practices. That seemed to hit their repayment collections there for a bit. Collections in Karnataka did dip down to about 96.3% in February 25, but they say it's gradually recovered to over 98.4% by June 25. So using those pre-save provisions helped absorb the shock from these events and kept their overall credit cost, the cost of bad loans, basically stable at 2.23%. Shows some foresight, I guess.
Okay, using provisions to smooth things out during tough times, that makes sense. But this brings up a broader point. Beyond the financials and the risk management, what about their wider impact, their commitment to being a responsible business, the ESG stuff and how they treat their people?
Right, and they do talk quite a bit about that. On the ESG front, environmental social governance, they have an NSE ESG rating of 74, which is considered pretty good. They also push this interesting concept they call true value, claiming that every rupee they invest creates 3 times the impact. It's their way of quantifying value beyond just profit, including social and environmental benefits. And they seem to be quite transparent, actually. They were apparently among the first NBFCs in India to report on the estimated carbon emissions financed through their retail loans in key areas like two-wheelers, farmer finance, and housing. That's quite forward-thinking. On the ground, their CSR work sounds impactful, too. They mention these digital Sakis, digitally trained women in villages who've apparently reached over 5.7 million people, boosting digital literacy. Plus, things like facilitating over 268,000 tree plantations designed to generate income for farmers, and supporting over 500,000 people during natural disasters.
That's quite a range of initiatives. And does that outward focus reflect internally? What about their own employees, their culture?
It seems to. They were just recertified as a great place to work for the upcoming fiscal year, FY26. And their employee satisfaction scores actually went up from 82 to 84, even with more people participating in the survey, 89% participation. That suggests a generally positive environment. They also highlighted their Udanan 2025 program. They've recently onboarded, I think it was 47, management and executive trainees from top universities. So they're clearly investing in building talent for the future, too.
Okay, so bring this all together then. What's the main takeaway for you, the listener, trying to understand where L&T Finance is heading? Well, as we wrap up this deep dive, it really feels like L&T Finance is in the midst of a very deliberate, significant overhaul. You've got those crucial investment grade ratings, a big stamp of approval, opening up global markets. Then there's the aggressive, almost complete shift to retail lending, which fundamentally changes their risk profile. And they're underpinning it all with heavy investment in AI for underwriting. They seem to be navigating challenges too, like using those provisions strategically while keeping an eye on customer quality and that broader social impact stuff. They're definitely reshaping themselves.
Yeah, what really stands out is how interconnected it all is. It's not just one thing, it's the disciplined move away from wholesale, embracing secured retail, adding new products like gold loans that fit that strategy, and then powering it all with digital tools and AI. It feels very methodical. This blend of being financially careful but also investing heavily in technology, even when dealing with traditionally tougher segments like rural finance, it points towards a pretty clear, resilient, long-term plan. They're definitely building something quite deliberately here.
So here's a final thought to leave you with. We're in this era of crazy fast digital change, shifting economic sands. How might a company like LTF, blending deep roots in places like rural India with these strategic buys and cutting-edge AI, how might that combination actually redefine what inclusive finance looks like? Not just for India, maybe, but could it be a model for other emerging markets facing similar kinds of needs and opportunities? What really stands out to you about their journey?